Some UK homeowners have quietly watched tens of thousands vanish from their property value in less than a year, and many didn't see it coming. Imagine opening a valuation update and seeing £40,000 gone. No fire, no damage, just the market shifting under your feet. Headlines now warn that UK house prices are falling fast, but the real story is more complex than panic and doom. Is this the start of a crash, a normal correction, or a rare window of opportunity? In this video, we'll break down what's truly happening using real housing data, lender reports, and market research. More importantly, we'll look at how smart homeowners are reacting right now, and what you should watch for next, before the market makes its next move. Number 1. Market Snapshot. Across the UK, the housing market has entered a noticeably different phase compared to the rapid price growth seen in previous years. Instead of bidding wars and homes selling within days, many areas are now seeing softer prices and more cautious buyers. In simple terms, the market is cooling. This doesn't mean every home is losing value, but the pace of growth has slowed, and in some places, prices have edged downward. One clear sign of this shift is time. Homes are sitting on the market longer. Properties that might have sold in a week during the boom are now taking months, with more price reductions appearing on listings. Sellers are gradually adjusting expectations, while buyers are taking their time, comparing options, and negotiating more firmly. However, it's important to understand that the UK housing market is not one single market. It's a collection of many local markets, each behaving differently. National averages can make headlines, but they often hide regional differences. For example, a commuter town with strong schools and transport links may hold value better than an area with weaker demand or oversupply. Likewise, certain property types, such as smaller flats versus family homes, can perform very differently at the same time in the same city. This is why broad statements like UK prices are falling don't tell the full story. The reality depends heavily on postcode, property type, and local demand. Another subtle change is buyer psychology. Many potential buyers are watching the market closely, waiting to see if prices dip further before committing. This waiting game can slow activity even more, creating a self-reinforcing cycle of caution. At the same time, life events, job moves, family needs, retirements, still push people to buy and sell, so the market never fully stops. The key takeaway from this snapshot is balance. The market is cooling, not collapsing, and local conditions matter more than ever. When you hear dramatic national headlines, it's worth asking a simple question. What is actually happening in your specific area? Number 2. Rate pressure. One of the biggest forces behind today's housing slowdown is something many homeowners feel but don't always see directly. Interest rates. When interest rates rise, borrowing money becomes more expensive, and since most homes are bought with mortgages, even a small rate increase can significantly change what buyers can afford. For example, a mortgage that felt comfortable at a low rate can suddenly cost hundreds of pounds more per month when rates climb. That extra cost doesn't just stretch budgets, it shrinks buying power. Buyers who once qualified for larger loans may now be approved for smaller amounts, which naturally pushes them to look at cheaper homes or delay buying altogether. When thousands of buyers face this reality at the same time, overall demand slows, and that softer demand can put downward pressure on prices. There's also a psychological effect. Higher rates make people more cautious. Buyers start asking, what if rates rise again? Or, should I wait? That hesitation reduces urgency in the market. Sellers then compete harder for fewer active buyers, sometimes lowering prices or accepting negotiations they would have rejected a year ago. This is a normal economic response, not a crisis, but it does reshape the market's rhythm. Importantly, rate pressure doesn't hit everyone equally. Cash buyers feel it less, while first-time buyers and those remortgaging often feel it most. Many homeowners coming off fixed-rate deals are only now discovering how different today's rates look compared to a few years ago. A smart move in this environment is preparation. Reviewing your mortgage terms early, understanding when your fixed deal ends, and exploring options ahead of time can prevent surprises. Even simple steps like overpaying slightly when possible or speaking with a mortgage advisor early can improve flexibility. Knowledge reduces stress, and planning creates choices. If you find insights like this helpful and want clear, practical breakdowns of what's happening in the property market, consider subscribing to the channel, liking the video, and sharing your thoughts in the comments about how interest rates have affected decisions around you. Number 3. Cost squeeze. Another powerful force shaping today's housing market is the everyday cost squeeze many households are feeling. Inflation has raised the prices of essentials, food, transport, and services, while energy bills, in particular, have taken a larger share of monthly budgets. For many families, the question is no longer just, can we afford a home? But, can we comfortably afford everything else if we move? When regular living costs rise, people naturally become more protective of their finances. This caution flows directly into the property market. Even those who technically qualify for a mortgage may hesitate to stretch themselves, choosing financial breathing room over bigger commitments. Research on consumer behavior consistently shows that when confidence drops, big-ticket decisions get delayed. Buying a home is one of the biggest financial choices most people ever make, so it's often the first thing families reconsider during uncertain times. Instead of upgrading to a larger house or moving to a new area, many choose to stay put, renovate slowly, or simply wait. This doesn't mean demand disappears, but it does mean it becomes more selective. Buyers spend longer comparing options, negotiating prices, and calculating total monthly costs beyond just the mortgage. There's also a strong emotional layer to this shift. A home is not just an investment, it's security. When the wider economic picture feels uncertain, stability becomes more valuable than change. Families may prioritize staying near schools, jobs, and support networks over taking risks with a new purchase. Parents often think about predictable expenses, childcare, and future planning before considering a move. This mindset naturally cools the pace of the market because fewer people feel urgency to transact. In many ways, this cost squeeze is quietly reshaping priorities. The focus moves from how big can we buy to how safe and sustainable is our lifestyle. That subtle shift in thinking, repeated across thousands of households, has a real impact on market activity. It reminds us that housing trends are not driven only by prices and rates, but by real-life financial comfort and the desire for stability in uncertain times. Number 4. Demand shift. One of the quieter but deeply influential changes in the housing market comes from how people now choose where to live. Remote and hybrid work have given many workers more flexibility than ever before, and that flexibility is reshaping demand. When commuting 5 days a week was the norm, living close to major city centers made sense despite higher prices. Now, for a growing number of professionals, being near the office every day is no longer necessary. As a result, some buyers are rethinking what they truly want from a home: more space, quieter surroundings, or better value for money, even if it means living farther from traditional job hubs. This shift has softened demand in certain high-cost cities and prime urban areas where prices were once driven by proximity to offices. Small flats in dense city centers, for example, may not feel as attractive to buyers who only commute occasionally. Meanwhile, towns, suburbs, and regions offering larger homes or greener environments at lower prices have gained attention. It's not a mass exodus, but a gradual rebalancing. When enough people make similar choices, local markets feel the difference. Some areas see slower growth or price adjustments, while others experience steady interest. Importantly, demand shifts are not just about lifestyle preferences but also about value. Buyers increasingly compare what their money can get them in different regions. If a similar budget buys a small flat in one place but a family home in another, the decision becomes practical, not just emotional. For homeowners and buyers alike, watching migration patterns, local job growth, and transport developments can offer clues about where demand may strengthen or weaken. Housing markets follow people, and where people choose to settle often signals where future demand will concentrate. Number 5. Risk groups. Not everyone in the housing market feels price changes in the same way. Some groups naturally feel more pressure when the market cools, especially those whose plans depend on timing. Short-term sellers, for example, are often the most exposed. If someone bought recently at higher prices and now needs to sell due to a job move or personal reasons, a softer market can mean smaller gains or even losses. Their flexibility is limited by time, and time is rarely a friend in a cooling market. The same applies to homeowners who stretched their budgets during peak prices and were counting on continued growth. Near-retirement owners can also feel uneasy during price dips. Many in this group view their home as a major part of their retirement security, sometimes planning to downsize and release equity. When prices soften, those plans may need adjusting. It doesn't mean those plans fail, but it can affect timing, expectations, and lifestyle choices. A slower market may require more patience when selling or more realism about achievable prices. Investors form another sensitive group. Buy-to-let owners, in particular, balance mortgage costs, taxes, maintenance, and rental yields. If prices stagnate while costs rise, returns can tighten. Investors who relied on quick appreciation may need to shift toward longer holding periods and stronger cash flow planning. For long-term homeowners, however, the picture is often less dramatic. If a home is primarily a place to live rather than a short-term investment, temporary price swings matter less. Housing markets historically move in cycles, and time tends to smooth volatility. This brings a useful reflection. Is your home a short-term asset you plan to trade, or a long-term base for your life? The answer often shapes how much market shifts truly affect you. Number 6. Smart responses. When headlines grow louder and market updates feel negative, the biggest advantage a homeowner can have is calm decision-making. Property markets are emotional by nature because homes are deeply personal and financially significant. Panic decisions, however, often lead to poor timing, rushing to sell in fear or making large financial moves without a clear plan. A calmer approach allows homeowners to separate short-term noise from long-term reality. Markets rise and cool in cycles, and reacting to every headline can create unnecessary stress and costly mistakes. Measured decisions, based on personal circumstances rather than media drama, tend to produce better outcomes. One practical response many homeowners consider is small, strategic improvements that help protect a property's appeal. This doesn't mean expensive overhauls. Often, modest upgrades like fresh paint, good maintenance, energy-efficient features, or improved curb appeal can make a home more attractive and competitive if selling becomes necessary. Buyers in cautious markets look closely at condition and running costs, so a well-maintained home stands out. These improvements also enhance everyday living, so the benefit isn't only financial. Another smart response is strengthening financial buffers. A healthy emergency fund, manageable debt levels, and awareness of mortgage terms provide breathing room if conditions shift. Financial flexibility reduces the pressure to make rushed decisions. Homeowners who know their numbers, monthly costs, renewal dates, and savings capacity, tend to feel more in control regardless of market headlines. There's also a productivity angle that often gets overlooked: information management. Constantly checking property news or price updates can drain focus and increase anxiety without improving decisions. A more effective approach is to schedule occasional, structured check-ins, perhaps monthly or quarterly, to review market conditions calmly. This protects both mental clarity and decision quality. In uncertain markets, discipline, preparation, and steady thinking often matter more than perfect timing. Number 7. Future outlook. Looking ahead, the future of the UK housing market is best understood through balanced possibilities rather than dramatic predictions. One realistic scenario is a mild correction, where prices soften modestly as higher borrowing costs and cautious buyers slow activity. This type of adjustment is a normal part of many property cycles and can help bring prices closer to what local incomes can support. Another possibility is stabilization, where prices level out and the market finds a new balance between buyers and sellers. In this case, activity may remain steady but slower, with fewer sharp movements in either direction. There is also the chance of regional rebounds. Property markets rarely move in perfect unison across the country. Some areas may recover faster due to strong local economies, new infrastructure, job growth, or desirable living conditions. Others may take longer to regain momentum. This regional variation is why broad national forecasts often miss local realities. Housing is deeply tied to local demand, and local demand depends on where people want and need to live. History offers an important perspective. UK property markets have gone through multiple ups and downs over decades, influenced by rates, inflation, employment, and policy changes. While short-term dips can feel worrying, long-term trends have generally reflected gradual growth alongside economic expansion. That doesn't guarantee smooth gains, but it shows that cycles are normal. For many homeowners, time in the market has historically mattered more than timing the market perfectly. The central lesson from past cycles is simple. Those who plan with a long-term view, realistic expectations, and financial discipline tend to navigate uncertainty more comfortably than those reacting to every short-term shift. In the end, markets reward calm thinking, not panic, and the homeowners who stay informed usually make the strongest moves. I'm curious about your area, so tell me honestly, are prices rising, flat, or falling where you live? Your experience helps others see the real picture. If this helped you, watch our previous video on property and financial trends, and support our work by subscribing. It's just one click, but it helps us keep creating well-researched videos for you.